Okay, ladies and gents, thanks for coming. We're obviously a few short, so we might have a few stragglers coming at some point. So I'm Alex, hello. Good to see some current clients and hopefully some new ones down the line as well. For those of you that haven't been to one of our events before, you're possibly wondering why a recruitment firm does regulatory events. Good question. Really it's just to try and differentiate ourselves, to try and attract guys like you to come to these types of events so that we can hopefully leverage off that to show you something different, as well as the good talent and everything else that these recruitment firms should be doing. But it's not about recruitment tonight, it's about PwC and solving all your problems on MiFID II. So please do utilise after the presentation, ask loads of questions. That's why they're here. That's the main focus of this, to really sort of get your questions and queries out. They might not be able to answer all of them, but they'll obviously do their best. And if there's anything they can't answer, they'll go away and try and find out, I guess. Yeah? So I'll pass you over to Claire and the team.
Nothing like setting us up to fail, saying that we're going to solve all your problems.
No problem.
Good evening. So I'm Claire Wallace. I'm a Senior Manager within PwC's Asset and Wealth Management Regulatory Practice. MiFID II has sort of been my life for the last 2 years, sadly, and is going to be my life for the next year. I'll just let the other guys introduce themselves and then we'll just talk about what we're going to do today.
Thanks. Hi, I'm John Newsom. I'm a manager in our Asset and Wealth Management Regulation team. I've worked with a range of our sort of buy and sell side clients on the investor protection topics, in particular under MiFID II. I'm also currently the chair of TISA's Product Governance Committee.
So I'm Luke Nelson. I'm a senior manager in PwC's regulatory practice. My experience on MiFID II has generally been with banking clients, so more on the markets and sell side issues. So I'll probably be covering those this evening.
So what we want to do, we've got an hour to talk to you, and you'll be glad to hear you're not going to talk probably for about a whole hour. We just want to give you a bit of little bit of background on, again, remind you what MiFID is and why we're here, a little bit on where we are with the legislative process, and also what we're seeing in terms of clients, and then really it's over to you guys. So I know there was lots of questions flying around beforehand in terms of things you're interested in and things you want to know. We're very happy to try and answer them. As I say, we probably can't answer all of them because there are certain things that we don't know the answers to yet, but we can maybe give you the comfort that not everyone knows the answers, so that's a good thing. So please encourage you to ask questions. This is kind of your time to ask us. If we can't answer it, as Alex said, our details are here. Please drop us an email and we will try and follow up with you. If you have questions as we go through, please feel free just to raise your hand and shout out. Otherwise, we can just take them at the end. So everyone should have the slide decks in front of you, which is not in your cushion, which is in your nice little cloth bag. Slide 4 really is it's a reminder of why we're here. So MiFID II is obviously one of the biggest pieces of European legislation that's coming down and that's hitting investment firms. Originally it was meant to come in January this year. Obviously they delayed it a year to allow for extra time for the regulators to think about what they needed to do and to give you your guidance. We now have an implementation date of 3rd of January 2018. And certainly the clients I've been working with recently, that has suddenly dawned on them that it isn't that far away. There's a few nods around the room, so everyone's probably in that same position. So we've got about 10 months until we have to go live. The thing to note, this isn't it doesn't have any transition period. This is a go live date, so 2nd of January or MiFID 1, 3rd of January or MiFID 2. So you have to be ready to go live. We'll talk to you as we go through about some of the things we're hearing from the regulator and where they are likely to focus on in the new year in terms of their supervisory approach and what we're looking at. But fundamentally, I'm sure as you're all aware, MiFID II is about enhancing investor protection and also greater transparency within the markets. In terms of MiFID I, it's bringing more instruments in scope and it's bringing much more requirements in scope. So some things are an update to existing MiFID and some things are completely new. But it's probably the most fundamental change that we've seen within investment firms since MiFID I came in 2007. Just on the next slide, what we have then is what we talk about the key impacts. When we first started talking to firms about this, we drew a model of a typical firm and had boxes that represented all the different functions, and we shaded them where MiFID II is impacting, and they impacted everywhere, and we decided that scared firms a little bit too much, so we changed our mind about how we were going to do that. But effectively, the two main types that you'll talk about in terms of the requirements, there's investor protection requirements, and so that's all about how you deal with your customer, how you sell to them, how you make products, how you set up your business, how you oversee things, and then the market side of things. So how you trade, how you transact, everything like that. And what we can see here is really the key impacts that we've got across the top. So obviously you've got your governance, record keeping compliance, conflicts of interest, etc. I won't read you through every single one of these, but what these do is just talk you through where the main parts of the directive actually impact on your business and what they mean. I'll pause there briefly. Is there anything on this sort of initial overview that anyone has any questions on?
So the safeguarding of client assets, given AIFMD and UCITS 5 requirements on the depository loan, strict liability and so forth, and under the AIFMD they're unable to contract out through that, but not in UCITS 5. What's the differential here and what's it adding?
So the safeguarding bit is really, it's bringing the rest of Europe up to the standards of the UK. So in the UK we have obviously our cash rules. And this is investment firms, this is MiFID firms that this applies to, and the FCA have got lots of detailed rules around CAS and have had done for many years and have enhanced them recently. What MiFID II is trying to do in terms of client assets and custody is actually bring it up, the rest of Europe up to speed with it, and everyone else up to the same level playing field. Yeah,
so I think just to add to that, talking to some of our European colleagues, there's a huge gap between some of the practice in the rest of the EU and the MiFID II client asset standards that just doesn't really exist in the UK. So I think for the UK there are some bits in terms of title transfer, collateral arrangements and things like that are new, but generally the lift and the gap is much smaller for UK firms, or it should be anyway.
But this is separate from, it doesn't impact on the IFMD or the UCITS requirements. So MiFID in itself is a completely separate regulation. Obviously some firms could be IFMD and subject to MiFID in some ways, but it's very much focused on the MiFID part of the business, not the IFMD part. Okay, I'll maybe hand over to John now, who will just talk us through sort of where we are in terms of the UK implementation of this.
Yeah, so I think I've gone the wrong way for this one. Yeah, I've gone the wrong way now.
What slide are you going for?
So, slide 7. So, we've had 4 consultations from the FCA now. We've had a discussion paper preceding that. I think we've had everything we're going to have on a what might we do perspective from the FCA. When we go through them, CPs 1 to 2, interesting enough, as clearly anything of this is, but probably CP3 is where the key issues were for asset managers, and we'll focus on that most. I think we're expecting 2 policy statements to come out from the FCA. So latest I've heard was certainly one will be coming out end of March, probably going to the FCA's board meeting in March, so we'd expect it end of March, perhaps start of April. And the second one in June, in time for the FCA to implement its rules by end of June and in time with the requirements.
We're heading for end of March, beginning of April for the FCA rules then, that's changed? What's changed?
We'll have some of them.
Yeah, so
they'll come out in 2 tranches. So
were you expecting the rules earlier or later?
Yeah, so what's going to go into the second tranche?
So I think our expectation is that the first tranche will be the rules that were in the consulted on the 3rd consultation.
Oh, okay.
So actually the more substantive conduct rules so that firms have adequate time to implement. And then probably the June will be the sort of the smaller, more technical changes to the handbook. The mop-up, yeah.
Yeah, I think the first policy statement will be the most interesting by far on how they're going to apply their requirements to AFMs and UCITS Mancos, if they intend to expand them out to those, what they're going to do on phone taking for certain firms and all that sort of thing. So if we go through CP1, so first consultation paper, really looking at a lot of the requirements that were set out in MiFID, the regulations, so far more known, less controversial in that it's determined what the end state will be. Clearly anything in this can be controversial from the perspective of do we agree with the rules or not. But more looking at the sort of requirements around the market side of it rather than investor protection, which came in CP3. Same with consultation paper 2, which was also...
In terms of the transparency in the venues, how did dark pools fit into this? Or did they?
So, I mean, one of the things that MiFID II is trying to do is kind of almost do away with as many dark pools. So, through a combination of the changes to the trading venue regime and the changes to the transparency regime, through the sort of the reduction in the way that waivers are able to be used, it's really trying to, as much as possible, eliminate the use of dark pools. So you've got things like systematic internalizers, which are being introduced. Anything that looks like a venue that's being crossed is going to really fall into the new organised trading facility definition. So the extent to which dark pools exist is probably going to be one of the things that really changes, and that it's going to be drastically reduced from the beginning of next year.
volatility. Are you aware of anybody who's saying that they're going to be an OTF? And if not, who do you think will be or possibly could be?
Shall I?
Yeah.
So I think certainly from my experience that there's still none of the big banks that are holding themselves up to be an OTF. I think partly the reason is they just don't see the commercial viability and sort of the issue that you can't be a systematic internaliser within the same legal entity. So we're not. I still haven't seen anyone jump. I think that there might be, as we get closer, we might see someone, maybe a big sell-side firm with a lot of flow, take the decision within one of its entities to operate an OTF. Aside from that, I think it's going to be sort of the infrastructure players like the Bloombergs, who are going to run those particular venues. But yeah, haven't seen any of the big banks jump yet. But that's not to say that we won't see that in the future. I don't know if there's.
Yeah, no, that's what we're seeing as well.
So going on to the second consultation paper, I think the two things that really struck me here were, and certainly where a lot of questions came about, was changes to the supervision manual around breaches and having to report any breach of any MiFID II requirement to the FCA. Struck a lot of firms, I think, as something different and new that they would have to focus on from a compliance reporting perspective. And also the complaints handling rules extending out to professional clients and not just covering retail clients and complaints from retail clients and the impact that would have. I think other than that, the changes here are fairly sort of minor from an asset management perspective, in my experience. And then moving on to CP3, clearly the sort of more weighted, more interesting consultation paper, certainly from my perspective, covering off inducements, product governance, research, independent versus non-independent for investment advice, all of the really big topics that I think are more important. I think going through them individually, the inducement rules are clearly continuing to raise a lot of questions with firms on how far they can push something before it's not in a client's best interest, and what will be possible under the new requirements. Part of that being the research rules, and I think we haven't really yet seen, we've seen some firms start to just pay for research themselves. They took a decision at the start of this year, and on an ongoing basis others are taking the same decision. I think a lot of others, certainly that I've been speaking to, are still waiting and seeing how they will react, whether they will go for a research payment account, whether they will go for a sort of CSA plus regime, or whether they will just take the hit on their own balance sheet. Certainly a lot of firms I spoke to, the immediate decision they took was they would take the hit themselves, and I think thinking through the actual financial implications of that running into the millions has meant that actually they're now revisiting and deciding whether they should charge clients for it instead of paying it for themselves. I think there's still no one way that people have come up with of doing that, and I think there's still a lot of questions around how you would actually make a research payment account work for yourselves and for clients, how you get them to pay for it up front, how you adapt to any increased research demands. I think there's still a lot of questions out there on that.
And I think as well, people are just considering how they use their research. So now they're having to potentially either pay for it themselves or set up this much more complicated process. People are really thinking, what is it we get? How do we use it? And actually, do we use it, or does it just come into us and gets put on the side of a desk and never looked at? So I think people are really considering what they use in a research point of view as well, before they kind of make that decision around whether they pay for it themselves or whether they set up the RPA account.
Yeah, and I know a lot of, sorry, go on.
Why do you think firms are reluctant to move from a dealing commissions-based model to a direct charge to the funds?
I think it's not so much that they're against. I think it's just some of the operational complications around the RPA that they feel is a headache. So I think because you have to set the RPA up on a per client basis, you set the amount up at the start of the year, you call off your research against that. I think certainly clients I've been speaking to, they just find that operationally quite difficult, and they prefer to have something either much cleaner, which is pay it off your balance sheet, or potentially stop using it if they actually don't get any value from it at the minute. So I think it's more that as opposed to the direct cost to the fund.
Yeah, sorry.
Sorry, I thought the RPAs you set it up at the strategy level rather than per client.
So I think they've now said you can set it up at strategy level, but you'd have to make sure that you're running two strategies that are identical enough that you could say it's at strategy level rather than at client level. I think for me, from a fund perspective, you kind of run into the question of, is it a new payment out of the fund, and if so, you're likely to have to go out and get investors to vote. It's probably woolly enough wording in a prospectus that allows you to get around that, but not necessarily. And it is just that the burden of having to set up this account and run. I think the cynic in me would say that it's been set up so that it is difficult enough and complicated enough that firms would rather not do it than do it if they have to. And I think that's why certainly a lot of firms decide we'll just pay it ourselves. It's not that big a cost rather than having to go through that process.
Do you have any thoughts on research about what the sell side are doing? So, you know, are they you know, how much are they charging? Are they going to stop sending stuff that's unsolicited? Are they working off their research departments? Because as an asset manager, we kind of want to see what the sell side are doing.
I think they're still trying to get their heads around it, and I think the difficulty with costing it is it's that point of what might be worth, say, £10 to you because you do a certain strategy might actually be worth £50 to me because I don't know anything about that particular stock or whatever it might be. So I think they're slightly concerned about doing themselves out of business a little bit by getting the costing wrong. They don't want to go too high because then nobody will have them, but if they go too low weekly, they lose that revenue. I think we'll see the bigger banks, I think, will work around this and they'll be okay. I think the danger is that we see the research market narrow because the smaller shops just can't compete and they can't. They'll struggle to compete with the big banks. I think there's a danger that we'll see it move. I've not seen anyone come out yet with, you know, this is how we're going to cost it and this is how we're going to talk to you.
I think
everyone's playing their cards very close to their chest still.
Well, they'll have to do that soon, right?
Yeah. I mean, I know one of them was thinking that they would charge on a per time spent looking at a web page basis. So if you spent 30 minutes, it would cost you X. If you spent an hour, it would cost you Y. And on that basis, and then if one person looked at it, or if 5 people looked at it, you kind of expand out based on that time basis.
Equities or fixed income or both?
Both. Yeah.
And the problem is I think the equities, there's a way around it and it's still complicated, but we can make it work. The difficulty is with the fixed income in terms of pulling out the research cost from the spread. So.
But yeah, I think, and there is also that unsolicited nature of it, that if you went by that pricing model, as soon as someone looks at it just to see what the research is, are you then paying for it? And you didn't actually want it. You just looked at it to see what it was, so you could know whether to reject it or not. And I don't think there's an answer to that yet. I mean, I've worked with a lot of firms that they're still struggling to get their heads around where they draw the line on a graph at where research becomes non-research and it becomes widely enough available that they can class it as sort of macro information, perhaps, rather than company-specific information they would class as
how
research.
long do you think this will sort of take to play out?
Yeah.
Do you think we're talking, 2020? I mean, when will it sort of play out, and we'll have a good sort of clear, understanding of how research operates in the world? It's not going to be January 2018. Right?
I mean, the sell side are under the same obligations the buy side are in terms of they've got the requirements that they have to have this costed out and worked out by January. The difficulty is at what point they're going to tell you that. So do they tell you on the 31st of December when you've got no time to change your systems? You'd like to think there would be much more collaboration, but to Luke's point, I think there's lots of secretness between the banks, be it the manufacturers making the products, be it the people selling the products. Everyone's kind of just working in their little silos, and I don't think there's as much sort of potential value chain discussions as there could be, because otherwise you're completely stuck. Have you tried to speak to your research houses, or have they just come back and said no? Or helpful.
But they can't actually talk to each other because of their coding issues. So that's what it is.
Yeah.
Not that they don't want to. I'm sure they will not.
So I think to your point around it shaking out. I mean, I don't know how long that will take, but I think what's pretty certain is whatever it looks like in January 2018 will be different to what it looks like in July and December.
I've spoken to a couple of fixed income houses recently who are ready to start going around and talking to clients about how they're going to price. Two different companies, two completely different ends of the scale in terms of how they're going to do it. But it seems to me that they are trying to price in a way that encourages as many people as possible to keep talking to them because they see the value in that conversation. They understand that
Yeah, I think some of the other areas of the consultation I think are interesting. Disclosure of costs and charges. I know that the FCA is moving away from producing a standardised template. I think are actually being pushed back towards producing something that firms can use to disclose costs and charges on a standardised basis across the market. Kind of goes against competition, but I know a lot of the industry bodies are pushing along those lines. I think a couple of the other bits that are interesting, client classification. I think we've had quite a few of our clients now thinking about whether they need to add retail permissions to their firms, because they have a lot of local authority clients that potentially will be retail clients in future. They don't particularly want to deal with retail across the board, but they want to still work with these local authorities, and so they're thinking of whether they need to add those permissions or not, or whether they will be able to opt up. Product governance, clearly a big issue across distribution and manufacturing. I think there's been a lot of talk recently in particular about the flow of information between the two, and whether I think there's a concern amongst distributors that manufacturers will be using this as an excuse to get a lot more data from distributors on anything that they can to cover their backs, and I think distributors will be wary of producing more information than they particularly need to. I think there's also still that concern as to what happens with customer complaints in future and how high up the chain they will go before someone is on the hook for it. And I know that a lot of firms are worried that this new requirement around target market assessment at both levels, not necessarily new, it's in the RPPD, but the sort of more formalised requirement to produce target market assessments, to be checking compatibility of your clients, of your investors against that on an ongoing basis, that there'll be a lot more risk of what you do if you think someone has sold your product to the wrong firm, to the wrong investor. Do you forcibly remove them? Do you have to go and talk to them? How sort of often do you have to do those sort of checks? I think there's still a lot of concern out there about that, and just generally about how you produce a target market assessment that's flexible enough and workable enough. I think the last one that was really interesting here, and we still hear a lot of our clients talk about, is telephone taping and just general record keeping around activities that could or potentially could lead to a transaction, and how to implement that. You know, the investment banks have been doing this forever. They record all of their staff phones. It's not an issue for them. In the asset management world, it will become a big issue, I think, in future. And certainly we've had a lot of firms struggling to find providers out there. It's not just in research where people are keeping cards close to their chest. I think on telephone taping in particular as well, our clients have been struggling to find providers out there that will offer a service to tape phones and make data recordable and searchable for 5 years afterwards. And I think that would be quite an issue to do that, and how you set where you draw a line on whether you are leading up to a deal or not. And I think firms are still struggling as to how to define that individually and make it so that you don't record everything, or you just take a decision to record everything. I think all firms, big and smaller, in the asset management world are really struggling with that. And then we had CP4. I haven't really spent any time on this. I think it's more of a technical consultation the FCA had to put out there rather than anything particularly interesting that they consulted on. And then if we move on to Europe, always an interesting discussion point. Slide 13, we've got a few of the consultations and papers that have been put out recently by the European Commission and by ESMA. I think the interesting thing for me has been that over the last couple of months we've really moved into sort of the level 3 of the process. So I think we're moving away now from the debate on the minutiae of the implementing rules. We're now really getting to that phase where we're getting the guidelines out there on product governance. We're getting a lot more Q&As out there on different topics, and I think, in my view, as someone that tends to spend a lot of time looking at this, I think we are getting to that more informative phase where we actually get answers to common sort of FAQs from ESMA about the topics that people are struggling with. Clearly they're not going to answer everything, and we're never going to get the answer to everything, but I think we are now getting into that phase where we probably have far more information than we had 3 months ago, far more information than we had a year ago, and getting to where there's not such an excuse anymore to say there's regulatory uncertainty, we don't quite know the answer. Keep moving backwards. So next couple of slides, I'm just going to look at the delegated directive and the delegated regulation, the level 2 measures, and have a look at how it changed from the ESMA technical advice. from a delegated director perspective, I think we've sort of covered a lot of these topics already, but research changed from the technical advice. Commission sharing agreements sort of came back into play for a lot of firms, and I think that's a definite benefit. We had a little bit more clarity on what might be classed as a minor non-monetary benefit, but I think it's still an area that certainly the UK is ahead of the rest of Europe anyway in what the FCA sees as being a sort of passable inducement or not, if I put it like that. You know, their thematic review last year was very clear that in the retail space they don't see sporting events as being conducive to client business and being charged back to clients. And I know that it's a very different approach in Europe, and certainly for firms that have US offices in particular, it's a very different approach to the SEC. So I think that's just generally one where the FCA is always going to be harder than anyone else. And going back to the safeguarding client assets point, there were a few changes there that took place mainly around the requirement for external audit to report to the FCA on safeguarding and whether firms are meeting their requirements or not. But clearly you already have that in the UK under CAS, where auditors will report to the FCA on CAS. So delegated regulation, I think there are some interesting changes here around product intervention and the types of information that must be provided to clients, and I think in particular on that point it's how it will align with whatever we end up with under PRIPS, which will be the most challenging point for firms. And I know that certainly as the rules exist at the moment, there are some divergences on types of information that has to be disclosed that make it difficult, and I think the delay to PRIPS is certainly beneficial. I don't know on the market side whether there's anything interesting here, Luke.
No, I don't think. I think they had the confirmation around the algorithmic trading definition, which was welcome, but nothing particularly interesting in terms of changes.
And then moving on to sort of what's left, and I know that the FCA recently opened up what it's calling its gateway for firms that are seeking authorisation for the first time under MiFID II in January. So I think we're still expecting perhaps some standardised forms to come out of ESMA for that, but I don't think it will change much of how you would apply to the FCA anyway. Most of what's left now is those sort of standardised template type documents rather than the real detail and the requirements that we're only left for the FCA really to come out on with that, I think.
Just can I just ask, in terms of the costs and charges reporting, the ex post reporting, do you have any idea on when the first statements are likely to be needed to be run? I mean, we still don't know, when is the first date and what's the period.
Yeah, it was a point we were discussing a couple of weeks ago at the Product Governance Committee, and I know that I think the FCA would be fairly comfortable if firms use next year as their starting point, and then you would sort of use the first year after that as being the time that you'd report. But I don't think that we've gone away from the risk yet that any period starting this year and ending next year you'd have to report for. So in theory, if you had your financial year or reporting period would be April to March, then you could potentially have to be collecting information for that period and reporting from end of March next year onwards.
So if you would normally report in the end of March, like December statement in April for the period ending March or something, and your first statement is due April 18, you either report for 3 months that are in scope from January to or you report from the whole 12 months from April 2017, or you forget about it entirely until...
Yeah, I mean, I think best case, and I think the FCA isn't averse to this, would be that you're reporting in April 2019. It would mirror the sort of approach that they always push with AFMD and UCITS on financial accounts. But I know that it was something that's been discussed with them quite a lot, but I guess their danger is that it's not something that they can necessarily control, and they might be told that it does have to be, and I would expect it actually to be, worst case would clearly be you'd be reporting on a full 12-month period from April to March, because you kind of either end up with one or other for me. Like the 3 months almost seems a bit pointless because you'd end up taking up too much time explaining why it's different, and it's going to confuse everyone. And I mean, no one says this isn't meant to be confusing for investors at the end of the day, but Yeah, I think the FCA will try and be as flexible as possible, albeit as flexible as possible, but implementing a lot of the rules to a higher standard than is required anyway, and across more firms than is required anyway. But I certainly think we'll get a lot more clarity from the FCA on what we do in those situations than certainly if you're operating in Ireland, Luxembourg, or anywhere else. So yeah, I think it's a wait and see.
Luke, do you want to share the conversation you had with the FCA recently?
Yeah, sure. So I mean, cover some of these points off on slide 19 actually. Just talking about really what the regulators' supervisory priorities are likely to be in the new year, and what some of its chief concerns are at the moment with the sort of the questions it's getting from firms. So I think no real surprises that in terms of supervisory priorities, it's going to be areas where it's conducted work over the past couple of years. So transaction reporting, it's obviously crucial to the work that the FCA does in terms of monitoring markets. So if it doesn't have, or it's not comfortable that it's getting that data, then that's problematic. So that's going to be an area, I think, probably number one in terms of where they're going to be looking at for firms getting the rules right. We know that that's going to be a challenge given the expanded transaction data fields and the expanded scope of instruments. So I think that's going to be up there in terms of priorities. The other area is best execution. Again, they've done a lot of work in the past couple of years on the back of their thematic review, particularly again with the sort of the application to different products. The MiFID II changes, and I'm sure you're all aware, are really around data and reporting there in best execution. But again, I think the other thing driving their priorities is with transaction reporting and best execution. The rules have been pretty finalised for a while, and particularly given the delay to go live date, I think the FCA will be expecting firms to get there pretty quickly in those two areas where it might not expect the same progress to be made on day one in other areas. A couple of other things linked to transaction reporting, trade reporting. So the regulator's got a particular concern for the buy side here at the moment, and that's really driven out of the delay to the systematic internaliser regime being switched on. So systematic internaliser calculations don't have to be run until September of 2018. So that means that a number of firms who will be SIs won't actually become SIs until much later after the MiFID II go live date. Firms can still opt up to be systematic internalisers from day one, but there's potentially this gap. And what the FCA is concerned about there is that for buy sides who might choose to interact with the systematic internaliser for best execution purposes, for trade reporting purposes, if they're not able to execute with an SI, then the obligation for trade reporting, which would with an SI always sit with the SI, would fall on that buy side participant. And the FCA is concerned that in that interim period, the buy side hasn't thought about how they're going to fulfil their trade reporting commitments in that interim period. So that's just something that we've been hearing.
Does that imply that a lot of people aren't going to sign up to APAs themselves and they're going to go the assistant reporting route?
I think that's what we're hearing. Yeah. So the FCA was keen that buy side explores between now and January actually signing up to APAs directly.
And what's your sense from talking to buy side firms in terms of how many people are going to get APAs themselves and how many people are going to go the assistant route?
I don't know, guys. Is there?
I've not.
No, yeah. So I mean, I don't tend to deal with buy side firms, but
They haven't come out and sort of said specifically. I think a lot of them haven't quite woken up to the fact. In some ways,
why the regulator's nervous.
that it's coming their way. So I think some of it is they just haven't thought. They don't know they need to think about it yet in a minute. But I haven't seen any sort of rushing forward to do it. Put it that way.
So that's one piece. I guess a couple of the other bits that I spoke to the regulator recently around third country issues and extraterritoriality. They said this is one of the topics where they're really getting most questions from firms at the moment, complicated by Brexit and EU withdrawal, of course. So all different manner of questions, particularly for firms that have a headquarter outside of the European Union, the extraterritorial effect. The FCA's line to us on this was, while MiFID II doesn't have any extraterritorial application in terms of the rules, for a number of firms with global structures, there will be indirect impact on parents who are outside of the scope of MiFID II, and those parents, it would be expected that they will do what they need to do to help the EU subsidiary discharge its compliance obligations. So I mean, we can read into that quite a lot in terms of the expectations, but ultimately the FCA's got no teeth outside of the EU. The Brexit question, I think, is interesting. It's obviously something that is going to colour the extraterritorial effect of MiFID II. We did hear that ESMA had actually, before the referendum, had prepared some material on the extraterritorial effect, a nice grid apparently, but the European Commission after June put the kibosh on that being published for fairly obvious reasons. So the FCA is getting loads of questions about that, but to be honest, it was saying that it hasn't got all the answers yet, and I think a lot of things are just going to have to be worked out. It quite likes firms coming up with their own conclusions and then talking to them about them and sort of proving them. So I think there is the good news is there is a bit of scope for interpretation, and if you've got your evidence as to why you've reached conclusions on scope for extraterritoriality, I think they will be somewhat sympathetic to that. So I think the FCA, as John was kind of saying, the FCA I think is going to be pragmatic in terms of enforcement, but there are a couple of areas where it's almost certainly going to concentrate efforts from day one.
And I guess just what we're seeing sort of across your peers in terms of what they're doing with the programme. So the larger firms and the medium-sized firms are very much fully into implementation. They're figuring this stuff out. They're working out where they still have the gaps. There are still a number of smaller firms who are not necessarily waiting. They've done some analysis, but they haven't done a lot of the thinking behind some of this. But that is on the smaller side as opposed to the larger size of the firm. But I think everyone's just struggling with the sort of issues that we've just spoken about in terms of how do they build their transaction reporting, how do they do it from an IT systems point of view, how do they get the data they need that sits wildly across the organisation into one place that they can do that transaction reporting with. The product governance stuff, I think everyone thought at first we've got this in rules at the moment, it worked guidance in the UK at the moment, it's not that big a deal, but as John was saying, as they've read into it and they've understood a lot more about the flows, they're realising how complicated that is, and actually they're trying to discuss with their distributors who equally don't want to talk about it in terms of how that will work. So I think that's some of the sort of the big challenges that people are coming through, but very happy to hear sort of any of the challenges people in the room are facing, if there's any other specific questions you've got. I think that was the main stuff we really wanted to talk to you about today, but very happy to take any questions that you may have.
So one of the things that I didn't see here, correct me if I've missed it, but is with regards to voice trade. Now, a few industry peers have said that that's quite a concern. That's one challenge is that with regards to timestamping. Have you got any view on that and how that looks like?
Yeah, I mean, I think we are expecting that the extent to which voice trading happens is going to be significantly diminished as a result of MiFID II. I think one of the big challenges is around pre-trade transparency. So I mean, I think there are a number of difficulties, and I'm not sure they're necessarily going to be resolved. And I think that the outcome might be that there is less voice trading, and we do see a greater electronification of markets. I think that's almost an inevitable consequence of MiFID II.
Share trading obligation. So do you think that fait accompli, or do you think there's room for interpretation regarding how that applies?
The equity trading obligation. Yeah. So I think that the key bit of uncertainty there for me is around the exemptions. So the infrequent nature of equity trading. So if it's not on a frequent basis, then there is this exemption. But what we haven't seen anything in the rules is around what that is determined, whether it's quantitative or how that's supposed to be interpreted in terms of the extent to which that's unorganised and infrequent, whether that has to be off.
So if I trade Apple on New York Stock Exchange, I always trade it there because that's all liquidity is. How could I class that as infrequent?
So I think there's an extra complication around third country venues. So if the New York Stock Exchange wasn't deemed an equivalent trading venue, then you might be prohibited from executing there, which would go against the best execution obligations, or where you've got the best liquidity. I think the equity trading obligation, if we think about the New York Stock Exchange being equivalent, then it really depends on how often you're conducting that, what sort of frequency you're conducting that trading activity. But I mean, if it's not deemed equivalent, then you're potentially going to have to do that within the. Does that answer your question?
I didn't. So on the people mentioned about the infrequent basis.
Yeah.
I didn't know whether there was like further room for interpretation and some of the.
So I think there is. I think that in the absence of any interpretation in the rules, and we'll see if we get any clarity on this in the coming months.
Someone having a lot more fun, I bet.
We could get some clarity in the coming months. What we are seeing is some of our clients using the systematic internalizer and quantitative thresholds to as a proxy for that frequency test. But I mean, I wouldn't recommend doing that because it's not in the rules.
So despite saying we wouldn't talk for nearly an hour, we kind of nearly have. So I know there's more drinks and some food outside, and we're here very happy to take any questions. You've got our details as well if anything comes up. But if there's no other questions, then I think that's probably it. Mark, so thank you for your attention.
Thank you. Yeah, as Claire said, there's more drinks, more food, so please go out there, network, and then there are more.
Any questions?